Well, the oil price continues to stay low. It was down under $40 a barrel, the latest that I looked. Now, that's been playing havoc, as we know, not only with oil exporting nations, but also with several Australian oil and gas producers. For more, I'm joined by Chad Slater, Co-Chief Investment Officer at Morphic Asset Management. Chad, thanks for joining us.
Thanks, Helen.
Let's start with the Fed decision, less than 24 hours away. There'll be no surprises, I would guess, you would think. But will a rise, assuming they do raise interest rates, cause some problem for some markets in the world?
Good question, Helen. We, as a house, don't think there will be flow-on effects and problems coming from this. But we also do think they are definitely going to rise. I think the rates markets are pricing in about an 85 to 90% probability, so it would be very surprising if they didn't increase rates tomorrow. But look, to be honest, it's really, what was quite interesting was there was a survey done of fund managers earlier in the week asking them what do they think the effects would be, and 55% said that they thought markets would rally on the confidence that they'd got the rate increase out of the way, and 45% said markets would fall, that now they've actually increased rates, that they'd be bad for countries that are reliant on exports, etc. So it's a really split decision out there.
All right, I want to move on to oil and what it means for Australia. But OPEC's most recent meeting, it was a bit of a disaster, wasn't it?
Yeah, it descended into farce ultimately in the end. There was, leading into it, there was a group of people who thought that Saudi, given they're running quite large deficits at the moment and they've got large capital account problems, they're redeeming about 20 billion a month of FX reserves, that they would ultimately have to give in and cut production. But in the end, the Saudis decided to up the ante and they've expanded production. So it was quite a chaotic meeting. I think the word cartel is probably not appropriate to be used to describe OPEC anymore. It's every man for themselves out there. And that obviously flowed through to oil prices, which dropped about 10% last week.
Right, so it was really interesting. I mean, why are they doing this? As you said, they've got deep pockets. But isn't it in the end going to hurt them?
Oh, absolutely. This is going to really hurt them a lot. They've decided that this is a war of attrition. That the original view at the start of the year would be, with low oil prices, that the large amount of... So, as your viewers may be aware, that US shale oil has been the biggest incremental producer of oil in the last year or so. That below $50, we'd see a lot of them shut down production, and we just haven't seen them go out of the market. And so Saudi's been bleeding down here, and they've decided that they're going to have to drive this even lower to maybe below 35, below 40, who knows. But at the end of the day, they've decided to get control of the market again, they're going to have to hurt themselves and hurt everyone else in the process. So
what does this mean for Australia and for our LNG sector?
Well, look, for Australia's not a large oil exporter anymore. It's a net importer, I think, these days. But from oil per se, for things like Santos, obviously that's bad. For LNG, LNG has a linker. Most contracts are long-term contracts which involve LNG price being linked to the oil price longer term, with a floor and also a ceiling put in there. The issue is that oil ultimately drives the longer-term spot relationship, and if spot prices are trading way below the floor, a lot of the customers will quite rightly go back to the people who are providing them the LNG going, look, this is really, really cheap in the spot market, why should I be buying it off you at a much higher price? So technically there is contracts there to stop this, but one wonders just how viable these contracts are longer term with spot trading so low. Like overnight, US natural gas prices made the lowest price in over a decade. Yeah,
but I mean, what does it do to capex into the future?
Oh, it's gone. There will be no capex, I think. The capex
we've already
is underway.
Spent billions and billions, so how we could justify more, I don't know.
Look, one of the interesting things about, or the unfortunate things about long-term projects is they will keep going no matter what at the moment. That these guys are so far deep into the capex profile, they're going to finish what they started. Yeah. And these projects are going to produce, and they're going to produce cash flow to try and service the interest on the debt they've taken on. So we will produce and we will keep doing it. What you won't see is any of the more marginal... So, for example, the Papua New Guinea LNG, which has got 2 trains online, will not probably bring a 3rd train online anytime soon. That said, PNG LNG gas is one of the cheaper ones.
Yeah,
but you've got all these sort of decisions, whether it be in Woodside, PNG, Gladstone, etc., which will have to decide what to do. And net, you'd have to think that they're not going to do incremental capex.
All right, I want to move on quickly. We've only got about a minute left. The share market has really been so lacklustre and depressing for many investors. Why should investors bother with equities?
A year is a short-term and a long-term investing time horizon. I want to point out for investors that over many, many years, equities have done very, very well for investors. So, but yeah, Aussie equities.
I know.
Yes, the long term is the sum of all the short terms, ultimately, though. But yes, this year's been a bad year for Aussie equity investors. I would point out that if you've invested in shares offshore, you're up double digits this year, so perhaps thinking about moving beyond your horizon of investing only in Aussie shares might be a good thing to do.
And of course, I guess if you really look over, 100 years or something of data, it's going to be a lot better than sticking it in a bank account, isn't it, even when interest rates were high?
Yeah, look, over 100 years of data, give or take, the number is you make about 8% a year out of shares. So that's still better than the 3% or so you've averaged over 100 years, and that 5% compound difference adds up. But I'd just suggest to your viewers that perhaps the world's a little bit larger than Australia, that there are, like, Japanese market this year is up 20% in Aussie dollar terms. There are opportunities out there in other parts of the world which are still quite interesting. There's places, even China, for all the gnashing of teeth and all the conversation you and I have had this year about it, they're up double digits in Aussie dollar terms. So there are opportunities. They've just got to perhaps look a little bit further than Rio and BHP.
Exactly. Well, hopefully one of you guys from Morphic will still join me next week, which is almost Christmas, but we'll talk about that. And thanks so much for today, Chad Slater.
Cheers. Thank you, Helen.
Across Australia, this is Business Agenda, and around the world, you're watching Australia Channel. Coming up, Senator Conchetta Fierravanti-Wells will join me in the studio to discuss what business needs to know about refugees entering the workforce here, ready to start work.